Good evening, everybody. Hope everybody can hear me. Um, we are live for a late night Q&A session about home loans. If you don't know who I am, my name is Larry Hughes. I'm a mortgage broker here in Southern California. I've been licensed to help families achieve their home ownership dreams since 2005. I helping clients finance since 2005. So if you need assistance, my contact information is in the live. As you see, my license numbers for compliance reasons is also in the live. DRE number 01487068. And my my NMLS license number is 324686. So yes, we're live, so folks. So we're gonna jump right into it. We're gonna jump right into the most recent question I got, and we might not get too many people on here this late night, but we're gonna go over some common questions I'm asked about home loans. So, what is a VA IRRRL? And I just did a mini class on it, a video I shot today. I'll post probably tomorrow. A VA IRRRL. Well, VA, start with the first part. A VA is Veteran Affairs, and those are home loans that are achieved by veterans who served in the military. They have a privilege of that type of loan, of getting that type of loan for them. It is, let me take this out, excuse me. It is a home loan that allows for a zero down payment, zero mortgage insurance, and with great interest rate, and it's guaranteed by the federal government. So, with how the IRRRL comes about is, let's say if you have a VA home loan on your home right now, you could refinance that VA to a lower interest rate if some conditions are met. And it's very easy for you to do that with no appraisal, no income documentation, as long as you meet some certain criteria. So what does the IRRRL stand for? So if you see on the board, it is interest rate reduction refinance loan. I'll tell you again, IRRRL, IRRRL is interest rate reduction refinance loan. And as long as you, one, are going to realize a half a point better in rate, VA will allow it. Can also, as long as the loan cost that you're going to incur getting this home loan, such as your escrow title and your other fees, as long as those savings can be recouped within 36 months, you also qualify for that IRRRL. And then the bank's levy what's called a FICO score overlay over that. And most banks are on a 620, 640, saying that you have to have a FICO score of that amount to get the IRRRL, the VA IRRRL. And then you can, again, refinance and probably skip one or two payments when you do that type of loan refinance. So for an example, let's say you're at a rate of 3.750, and in the VA IRRRL, you can get a rate, you were quoted a rate of 2.5. So of course that is more than a half a point savings, right? And then as long as your cost for that loan can be recouped within 36 months, and you have a 620, 640 FICO score, you can again qualify for the VA IRRRL. And what that is, again, what the benefits are, is it's a streamlined process of refinancing. No income documentation needed, no appraisal. Right? The whole point about a VA interest rate reduction refinance loan is that if you've been making, I'm sorry, now I skipped something. Another qualification is you've had to make 12 in the past 12 months, you've had to be able to make those payments on time, right? So again, the qualification is half a point, recoup your cost for the loan within 36 months, and then the last 12 months of your loan, you've had to make all the payments on time, no late. So the thinking behind the VA IRRRL is if you've been making those payments for the last 12 months without a late, and the other two qualifications, that reducing the loan will only make things better for you, right? So if you're going to realize a couple $100 in savings, you'll be that much more be able to make the payment. So they don't see it as a negative or a qualifying flag if you're going to do a VA IRRRL. So yeah, that's that. Turn on Instagram too. Excuse me. um, what else did I want to see about the VA IRRRL? One last thing. Like I mentioned, if you are in the if you are trying to do a VA IRRRL and you again don't have a FICO score of 620, 640, there is one of my lenders that I deal with, and I'm dealing with over 40 lenders that do not have a FICO score requirement and actually have a no FICO score program. So let me explain that. So we know the entire world has went through this whole crisis, right? And in this crisis, you could have lost your job. You could have let other debts go, crazy, and credit card debt. And so it dropped your FICO score. So as I previously told you, you've had to have a 620, 640 FICO score to finance with most lenders on this VA IRRRL. However, this lender has a no FICO score VA IRRRL program where you could literally refinance and don't even report a FICO score. So your FICO score could be in the toilet, and you can do a VA IRRRL. And this is not a cash out. This is a interest rate reduction refinance loan, and you could refinance with again no appraisal and no job verification, no income based verification. You could have credit could have been bad. You could have lost your job. As long as you've been able to make your payments, they don't care. They do a no FICO score, leaving able to make your payments, recoup the cost within 36 months, and realize a 50%, a half percent better in rate. And you can do this via IRRRL now. It may be slightly more expensive or more or costly than it would be if you had the FICO score. So maybe anywhere from 3/8 of a point to a half a point. But you can still do a VA refinance loan with that. Okay, some other common questions I have all the time is, and as far as a VA, one of the common questions I get is, I'm a son or daughter of a veteran, can I use my dad's or mom's veteran benefits to help me buy a house? I mean, I'm gonna go on there. I have the income, he has the credit and the benefits, and I want to go and buy a house using my dad's VA benefits. Well, the VA says absolutely not. The only person that can use VA benefits, you can't even be on the loan with them, is either the veteran himself, him or herself, or him and her surviving spouse or spouse. So it's either the veteran alone, or the veteran and the spouse, or the surviving spouse, or the surviving spouse, right? So you can't, as a kid, grandkid, anything like that, go on a VA loan with the veteran. They won't even allow your income to be qualified. You can't. He can't buy you the house, right? A VA program is for. Oh, did my camera go on? VA program is for. Excuse me, what's going on? The VA program is for. It's an owner occupied program. It's a not for a non-owner occupied. So if the veteran owns the house, if the veteran does not plan to live there, then it's not a program you can get into. So if you have any questions or you're just joining, my name is Larry Hughes and my license number at the bottom, and I'm talking about questions that I commonly get when dealing with the veteran VA program. If you have a question, feel free to leave a question in a comment below, and I'll make sure I get to it. But right now, I'm just going over the questions I get, and and let me know if you have any questions about any loan questions you may have. So, since we covered VA a little bit, let's cover FHA. Most common FHA questions are: one, what is the minimum FICO score for FHA? Well, FHA says that the minimum FICO score they'll take is a 500. However, banks have, or lenders have, what's called an overlay, which they're allowed to overlay, since they're the one lending the money. They're allowed to overlay their own requirements over FHA's requirements. So FHA says the minimum FICO score is 500. ABC Mortgage says the minimum FICO score for us is 640. So if you are looking for a VA loan, I have lenders that will take you all the way down to a 580, but there are different restrictions in place. Meaning the FICO score maybe have to be high. The down payment have to be higher. The debt to income ratio is more strict. Stuff like that. So you are golden, however, I find with most lenders after about 640, and you're really golden at 660. So the minimum FICO score I will be shooting for if I were a borrower in this market is a 660 FICO score. What's the minimum down payment for FHA? 3.5%. Again, 3.5%. So if you're buying a $300,000 house, that down payment is 10.5, right? So 300,000 times 3.5% is 10.5. The next commonly question I get about FHA is, can I borrow the down payment? I don't physically have the down payment. Can I borrow the down payment? The answer to that question is no. You cannot borrow the down payment because the word borrow indicates that a repayment on that loan, because you borrowed it, is going to be due sometime in the future, and then we're going to need to count that against you towards your debt to income ratio. So no, you cannot borrow the funds. However, someone can give you the funds, right? You can get a gift of your down payment. Your father, your mother, a third party, your uncle can give you the money. It will have to be tracked, but yes, you can get a gift for your down payment, no problem. The next commonly question I ask is FHA acceptable in the marketplace right now? And yes, it's still acceptable in the marketplace. Competitive as it is, FHA is acceptable in the marketplace on a home that does not have any health and safety issues, right? Because if the house has some health and safety issues, then FHA will call it out in the appraisal, and those issues will have to be addressed. So, an agent representing a house that's going to accept an offer on an FHA property, FHA loan, will review the house to make sure it will pass the FHA inspection. And typically, what FHA looks for again is health and safety issues. They're real big on chipped paint, broken tiles, leaks, stuff like that. Deterioration in the roof. Active brown marks on the ceiling. So if you looking at a house like that and you have to use FHA financing because that's the way your bank account is set up, then you may want to keep looking because FHA will call that out, and then you and the seller will have to come to an agreement or a structure on how to address those issues. What other questions do I get? Commonly asked questions about FHA. Let's see here. Commonly asked questions. So you can't borrow. We know that you can't borrow. Our FHA loans easy to obtain? Yes, it is easy to qualify for FHA because FHA has more lenient than conventional loans when it comes time to when it's time to borrow money. FHA has their debt to income ratio will be a lot higher in tolerance versus conventional, right? So if you have to, conventional says that you can go up to 49.9%, right? Um, However, FHA says FHA you can go up to 54%. The conventional wisdom um, on conventional is that you should stay at 45%, right? Should stay at 45%. Most lenders are at a hard cutoff at 45%, but that's why FHA is more lenient. FHA is more attractive because it is more lenient and it goes all the way up to, again, 54%. But I try to qualify at the 50% mark. Another commonly asked question is we answered what's the average FICO score? Again, the average FICO score for FHA, I would say shoot for is a 660. Is FHA for first-time home buyers? No. FHA is not a first-time home buyer program. However, it is a owner-occupied buyer program, meaning that if you are planning to get a home using the FHA FICO score, FHA program, that you have to live in the property. There's an occupancy requirement for at least 1 year. You have to live in the property. After that, you can go ahead and rent it out, but it's spelled out in the loan docs that you have to, again, occupy the property for at least 1 year. So that's that. Let's see here. Is FHA just for low income borrowers? No, FHA does not have a income limit like some programs, like the Home Possible program and all that stuff. They have an income limit. FHA doesn't have an income limit. You can make $500,000, and if you still want an FHA loan, you can get one. There's no problem. 3.5% down, you can get one. But when you're making that much money, you have a lot more assets, and you can put down a lot more. So it'll probably make sense at the higher FICO scores and in the higher down payment to go with a conventional loan. The next common question I get is, what about the mortgage insurance on the FHA loan? Well, mortgage insurance is mandated by FHA, right? So for the privilege of only putting down 3.5%, FHA says you have to have some type of insurance that insures the lender against loss, not you, but the lender against loss. And that what makes the lender more attracted to want to have that because they're insured. You're paying for insurance every month against loss. And that insurance is at a factor of 0.85% of the loan amount each month, right? So I've seen when you do the calculation, depending on the loan amount, but I've seen anywhere from anywhere from $250 to $450 for a month for the mortgage insurance, right? Right now, rates are great. So the principal and interest payment in that equation is good, but just for the mortgage insurance, I've seen, a few $100s, to say the least. How much income is needed to qualify? Now that depends on how much house you have, right? How much house you're wanting to buy. What is the price of the home, and what is the price of the home, and how much personal debt do you have reporting on your particular credit report, right? So you're looking at what we use to qualify for FHA is the principal, interest, tax, and insurance payment. So that, let's just say, for instance, that's $3,500. And I just told you that I like to qualify my borrowers at the 50% debt to income ratio. So let's assume that this person I'm qualifying has zero consumer debt, meaning all the credit cards are paid off, the house is paid off, the car is paid off, and they don't have any student loan debts. So they will make, at the 50% mark and the payment is $3,500, they would need to make $7,000 a month. So yeah, let's answer that question. So again, that's how the DTI is. The DTI is what's called the debt to income. I also answered another Question is, do I make too much money to qualify? No, you don't. You don't make too much money to qualify for FHA. You can make as much money as you can. How long do FHA loans take to close? Now, we could close FHA loan here at Elite One Mortgage in as little as 21 days. Actually, we've closed at our office. We closed them in as little as 14, 13 days. However, what's taking long in this market right now is the appraisals, right? Everyone's getting a loan. Everyone's doing a reverse mortgage. Everyone's doing FHAs, conventionals, buying houses. So the appraisals are taking a real long time. So barring any appraisal issue that we'd have, we'll probably order a rush. I know I do for the most part, and we can get this loan closed as long as we have a cooperative buyer. We can get this, meaning that, if I ask you for some paperwork, a set of paperwork, it doesn't take you 5 days to get it to me. You can relatively fast scan it and send it over to me, or upload it yourself to our system. We can close the deal in 13, 14 days, 21 days on the outset. Why would I be turned down for FHA? You don't meet the FICO requirements. You don't meet the income requirements. You are delinquent in any student loan debt, meaning that you've not been paying your student loan debt and it's just in collections, etc. FHA, speaking of student loan debts, FHA has changed the way they look at student loan debt in the past. And it just happened recently. I don't know, last few months recently. In the past, FHA will look at student loan debt and say that you need to hit the borrower with 1% of their student loan debt monthly. So if you owe $100,000 on your student loan debt, FHA said I had to hit you with $1,000, like it's a bill or car note that goes against your debt to income ratio monthly. Well, that's not good. That's not reality, right? What FHA did was move into reality. Most people are on what's called an IBR, income-based repayment plan. An income-based repayment plan is not amortized to be paid off on a certain schedule. So they really stretch it out. And if you're on an income-based repayment plan and you owe $100,000, your payment depend on, the counselor, et cetera. But let's just say, for instance, your payment is $100. What FHA previously said, we can't use $100 for your payment. We have to hit you again with a 1% of your total loan amount, and that is $1,000. So you see, there's a $900 gap in buying power, and that has thrown people out of the market altogether because out of what they want to be able to afford, because of us having to hit them according to the guidelines with that as $1,000 a month debt, when in reality they're only paying $100 a month because they're in an income-based repayment plan. So that is what happened with the that's how FHA now looks at student loan debt. Credit check. We run your credit in any loan, FHA, conventional, VA. We run your credit, and then the actual end lender runs the credit too in the beginning of the application and at the end of the application. Closing costs. Can the seller pay closing costs? Yes, the seller in a transaction going FHA can pay up to 6% of your closing costs, non-reoccurring and reoccurring closing costs, 6%. Now, another question is, what if, when in the process of the appraisal, what if the house does not appraise? You go in a contract for $575,000 to buy your first home, and the appraiser comes out after you pay them $575 to come out and appraise the property, because that is a requirement of the lender. You come out and appraise the property, and he appraises the property at $525,000. $575 is the contract price. $525 is what he brings it in at, what the value is at. So there's a $50,000 difference. What happens? In most cases, in years past, the seller will come down to their appraised value and accept that appraised value as the actual value of the home and sell it to the person and move on. Now, in this market, since there are so many offers, out there and it's a very competitive market, sellers are asking the buyers to pay that difference, or they're splitting in half and half. So we're talking about $50,000 coming out of your pocket extra to buy the home. Or maybe they come to agreement and says, I'll take 25,000 more. 25,000, so 550,000. Sell the home for 550,000 instead of 575. They'll split the difference. But that's what I've experienced. But that again is up to what you experience and other lenders or realtors have experienced. Can an FHA loan be refinanced? Yes, of course. The FHA loan can be refinanced, and in most cases, it's a streamlined refinance. You don't have to ask for income documentation and/or appraisal, as long as, again, you've been making the payments for the past 12 months and you realize a certain amount of savings. FHA will allow you to refinance that property. Now, that question bothers me sometimes when I get it because of some unscrupulous things that happen in our industry before. What some people say, hey, get this property and then we just refinance you out in 6 months. So what do you mean? So that means you're selling the buyer a higher rate? I don't know if I agree with that or not. I don't know if I agree with that totally. Yes, it'll take 6 months before FHA will allow you to refinance. But what is your goal? Is your goal to pull out money? That means you have to actually qualify for that. Is your goal to refinance to see hopefully there's a better rate? That's great, but don't bank on it. I'm not going to bank on it. I'm not going to tell you that it's going to be a better rate. And then I see you in a grocery store because I know and live in the area I serve. See you in a grocery store and you say, I lied to you at all. No. It depends on the market. I cannot guarantee the market in 6 months. Can't guarantee if the next day what it's going to do. Any day now, these rates can start going sky high. Right now, we're in a great position. Historic rates are at a historic all-time lows. How are FHA rates determined? Okay, so that depends on your goals, talking with your mortgage broker. If you're dealing with a mortgage broker, I should say, what you want to do is have that candid conversation with your mortgage broker and see if what the rates are. What rates does he or she have, right? What we typically do as a mortgage brokering industry, we give you what's called our par rate. Oh no, let's see here. Can you see the board? So let's say with your FICO score, you could get a 2.5% interest rate at what's called par. So that's an old golf, or not an old, that's a golf analogy. Well, par is at an even, right? It's even. It's not below, it's not above. So if you can get a 2.5% at par, and let's say if that's, you're not getting credit and it's not costing you anything to get this rate, that's what it is. No credit. Par is no credit, no cost. Now let's say you credit CRE. Let's say if you want a credit for the interest rate, let's say you would say, Larry, I need some closing cost credit from the lender. So I'm willing to do a 2.75% interest rate. And then I will look up the rates on that day and say, okay, at a 2.75% rate, it's slightly worse than the 2.5%, but the lender will give you a credit of, you were using it as an example, of $1,400. That's going to your closing cost, right? They'll give you a credit of $1,400 to be applied to your closing cost. Now, you're going to pay a slightly higher, payment here at the 2.75 than you were at the 2.5. But now let's say on the other end, you said, I want a lower rate than 2.5. I want a 2.225. I want a 2.250 rate. That's lower than the 205, than the 2.5. So you want that rate. It's going to cost you now. It's going to cost you money. And the lender is going to say, okay, we'll give you that rate, but it's going to cost you as the borrower, is going to cost you $800. In addition to your down payment and your closing costs. To get this rate at 2.25, it's going to cost you more. It's going to cost you a little bit more money. It's going to cost you $800, right? But again, when we quote you a rate at par, that means there's no credit and there's no cost. It's an even rate, right? So working with a mortgage broker allows you, like myself, allows you to, fluctuate and use that to your advantage, right? Because if you needed that $1,400 credit, or you wanted,